What's up, guys? Welcome back to Everyday Money. Now, when you're looking on YouTube, there probably every day there is a brand new video about how the market's going to crash, be it the stock market, the housing market, crypto market, whatever market it is. And they'll always have some sort of reason why they think it's going to crash, be it that the prices of the stocks are just higher than they've ever been, which happens all the time because stock prices always go up, or homes aren't affordable, or lumber is too expensive, or PE ratios are out of whack, or just Bitcoin is going through the roof, so it obviously has to crash, right? And the answer to that is yes. There absolutely will be a market crash of some sort in some period of time. The fact of the matter is that crashes, corrections, pullbacks, things of that nature happen all the time, and it is a very regular occurrence. And so you need to be able to prepare yourself for the next market crash or correction or bear market at any time, because you never know when it's going to happen. So like I said, crashes, pullbacks, corrections, declines, bear markets, all of these things happen relatively often. And obviously, the lower percentage ones happen more often than the larger percentage ones, but the stocks going down and even housing going down for a brief period of time is a very normal and a very good thing for the markets, because it does allow some resetting of markets and for people to be able to buy in and push those markets to new highs. But I pulled some statistics on averages for the S&P 500, and during the last 100 or 150 years or so, the S&P 500 has a pullback of approximately 5% 3 times a year. So 3 times a year, you are going to see a 5% pullback. And it is going to seem like the end of the world. YouTube is going to be going crazy. Twitter is going to be going crazy. All the social medias are going to be going crazy. All of the major media is going to be going crazy. CNBC will have it on nonstop that the market is down 5%. And, we're getting close to that 7% circuit breaker in the market. But that is going to happen on average 3 times a year. Very regular occurrence. A 10% correction in the markets happens on average every 16 months. So, about every year and a half or so, you're going to be looking at a 10% correction. Again, going to be a major news item in everything, in the official news and then in the social media news like this channel and so many others. And then there will be a 20% decline, putting stock markets in what is typically considered a bear market every 7 years. So, in 14 years, probably see 2 of them. Now, the big ones, the market crashes, which really don't have a set percentage amount, but is just widely regarded as a double-digit steep loss across a wide swath of the market. So we're not talking about just tech getting hammered. We're not talking about utilities or consumer cyclicals or whatever getting hammered. We're talking about broad market declines, very steep declines over the course of a couple days, or a very steep decline over a couple months. And these happen far less frequently than your pullbacks, corrections, or crashes. The big ones that I pulled from all the data was the 1929 crash. That was pretty bad. Pretty bad. That was the worst in history. 1987 during Black Monday, the 1999 through 2000 dot-com burst, and then the more probably recently remembered 2008 credit in housing bubble, where pretty much again worldwide meltdown that started in the United States because of bad mortgages going bad, banks going under, and credit markets freezing up. So over that 80 or so years, we had 4 major market crashes of significance. So what are you going to do to prepare for these market crashes that come along, these downturns and such? What are you going to do to make sure that you don't lose all of your holdings, you don't lose all of your money? Because people have been predicting market crashes all the time for probably as long as there's been something to invest in. For example, in recent memory, since the 2008 market crash, consistently people have been saying the market's going to crash in 2009, 2012, and 2015, and 2000. 18, you know, on and on and on, the market is going to crash. So if you stayed on the sidelines and you didn't have your money in the market because you saw that XYZ expert or a YouTube guy like me said it's going to crash, you would have missed out from the lows of 2008 on a almost 510% return in the S&P 500. You have to prepare yourself mentally and not necessarily look at what everyone is telling you. And here is how I do it, and here's how you can probably do it as well. What I like to do is just look at my holdings and think about what a 10 or 20 or 50% drop in my numbers on my screen would look like, because that's what a lot of people do is they see the numbers on the screen going down, 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 and they haven't considered that. They've just looked at what they have and what the next year should be if they think they're going to get a 10% return or whatever, but they haven't looked at what a 10 to 50% downturn would look like. And if you already have that visualized, it won't be as startling when it actually happens. And another thing to look at is not the dollar amount associated with your account. It's how many shares you have. And if you have solid companies or you have very good index funds like a total market fund or an S&P fund or whatever, or you have awesome blue chip companies like P&G or AT&T or Verizon or any one of the other blue chip companies that you know will be in business and their stock price decline is just along with the rest of the market, you know that you can look at those shares and be like, I still have the same amount of shares. And so when the price comes back up to what it was, which it has historically done every time and exceeded that share price, that you will still have that amount of money at the end of the day. You have to limit yourself from panic selling. And I can't say this enough, is that when the markets are going down and you're watching that money evaporate and you are like, ugh, I'm losing all this money, I have to sell this now to lock this in. If it's already gone down 10 or 20%, you have already lost. Don't lock in those losses, because once you sell those shares, that dollar amount is going to be what you lock in at. And so if you do, you have lost. So you need to not panic sell, especially if you're in a position like I am, where I'm in my mid 30s and I have a lot longer on my investment horizon. And when I look at my analytics on my channel, most of you guys are in the 20s, 30s, and 40s that watch this channel. And so that is what I do, and that is what I would recommend if I were a financial advisor, which I'm not, so this is not financial advice, obviously. You need to remember that the market always goes up over time. Every one of those crashes I told you about before, from the Great Depression to the Great Recession, the market has exceeded those levels every single time in a long-term outlook. So if you have, 2,000 shares and they're worth $100 and they go down to $10, you can pretty much be guaranteed, if they're in solid companies and these aren't like risky bet type of companies or ETFs, that those prices will return to their original price and then go higher over time. Another thing to do is not sit on the sidelines while, people are saying that the market is going to crash. It's going to, it's always going to crash. Every year and day, the market is going to crash according to somebody. The old adage is that time in the market beats timing the market, and that is exactly the case. Nobody can reliably time the market and say exactly when we're at a peak, exactly when we're at a valley, except when you're looking back with the 2020 vision. You have to keep on investing, and this is what I try to stress to people is just dollar cost average, or just put in as much as you can if you don't have just a set amount of money that you can invest right now. And if you do have that set amount of money, like, $10, $20, $30, $50,000, and you can put that in right now, it behooves you to invest all of it. And I know that that's a scary thing to do, but just mathematically, it's the best way to do it. But if you sit on the sidelines and you do not invest, you will lose out on gains on the way up before the market corrects or crashes or whatever. For example, if you put $10,000 annually into an investment that returns 10% and you do that for 5 years. At the end of that 5 years, you would have $67,000. If the markets crash by 20% at the very end of that 5-year mark, you would still have $53,600, which is $3,600 more than if you would have just put your money into a savings account where it would have been eroded down by inflation to a purchasing power of $43,000. Now, granted, $3,600 isn't a lot over 5 years, you know, versus the $50,000 that you started with. However, these downturns, these corrections, these bear markets are typically short-lived, and within a very short period of time, you know, historically speaking, that will start going back up and it will exceed that 20% downturn that it started at. Not only that, while it's down at that 20% level, you are going to be purchasing shares at a cheaper price. Your dividends are going to be reinvested into more shares at a cheaper price. And so at the end of that correction or bear market or whatever, you are going to end up being farther ahead than if you than you would have been anyhow. Now I had here on my little outline, the section for this title was "If It Does Happen." That's a stupid title because it is when it will happen. Because again, it's statistically shown that these things happen. 5%, 10%, 20%, even 50% declines. They will happen. And so here is what to do if it's happening right now and you're in full-blown panic mode. If you are so loss averse or so risk averse to losing that dollar amount, you can have stop loss orders on your account that are just good until triggered. And you'll have to continually redo these if you want it for a set dollar amount. Some brokerages have, like if the market declines or the security declines by 10%, it'll trigger that. But again, you lock in the gains that you have, and you do prevent some loss, but it had to have come down some amount in order for that to be triggered. So you do lock in some gains. But if you are further along in life, you're older, and you really need to defend that amount of money that you have for your retirement or whatever, this is probably a good thing for you. It's not what I'm going to do. I don't have a single stop loss or stop order in because I am willing to ride the waves of the stock market from now until for the next 30 years or so. But the second biggest thing to do is to not panic sell and lock in your losses. And I just said that in the previous section, but it bears repeating. If you panic sell once the market has declined 20%, you have locked in those losses. Now the chances of that going much further below that 20% are not great. Essentially 4 or so times in the last 80 years has the market really crashed. And then again, every time it has recovered over 100%. This is a great time when the markets are low, be it 5, 10, 20, 50%, whatever, to buy more. So what you can do is you can increase your purchases, and it's possible to buy more shares of the same companies, the same ETFs that you were buying before with the same amount of money. And so when that does go up, you will have even more money because you have more shares of these high quality companies that you've been investing in. And the only problem that you're going to have is that you didn't buy more. The biggest thing to remember is that the markets always go up, be it stock market, real estate market, whatever. And even though you think that the markets are super high, if you look back into the 80s when the S&P was in the 200s, people would have never dreamed it would be in the 4,000s. And I put out a video a little while ago that says that the S&P 500 will be at 8,000 in about 100 months. And that is probably mind-blowing to some folks. But when you start doing the math on these things and look at things historically, you will see that the markets always go up. The same with homes, the same with real estate, the same with probably cryptocurrency. Everything is always going to go up over time. So guys, yes, the next market crash or downturn or whatever, it is coming. But literally nobody can tell you when it is going to be. It could happen while I'm publishing this video. It could be 10 years from now. It could be 5 years from now. No one can say, but it is important for you to get yourself ready as far as putting yourself in a position where you will not be hurt by a market downturn, where you are mentally prepared. That is the biggest one, the mental preparation for a market downturn and seeing that those dollar signs in your account go down. That is probably the number one thing for you to get your head around, because if you don't panic sell, if you continue to invest money into that down market, I can almost guarantee you that on the other side of that, you are going to be doing far better than if you would have either stopped investing altogether, or even worse, if you would have sold off your positions or your real estate or whatever it is that you're invested in. Guys, if you like this video, feel like it helped you out, be sure to hit that like button for me. It really helps me out. The YouTube algorithm spreads it all over the YouTube verse. If you're not subscribed to this channel yet, hit that subscribe button to grow your wealth, increase your success, put you on the road to financial freedom. I appreciate you guys watching today, and I'll see you on the next.